what the market's got for you this morning. What a great day it is for America, and treasonous people around this country need to stand down. You're done.
Jerry Garcia's birthday today too.
Hey, happy birthday, Jerry, belated.
Dude, before I go on to the markets, I will talk about my rant. And they were showing Colin Kaepernick this morning. He's trying to make a comeback.
Right.
And you know what I'm really sick of hearing about? I'm really sick of hearing about what a bad guy Columbus was. Okay. And, I've read Columbus's writings, and basically Columbus got here and it wasn't this like Garden of Eden. Okay. There was a tribe that he became friends with, and they tried to give him and this is his writings, right? It's like in his journals. They tried to give him like 10 or 15 kids that were like 5 to 10 years old that were fattened up to eat. They wanted him to bring these kids to the king of Spain and give it to him to eat. So not only were the Native Americans enslaving each other, they were literally growing people to eat. Now that's
Damn.
pretty effed up. I mean, you don't hear Colin Kaepernick talk about that.
No, well, I've never. I guess I need to read about Columbus. Then I didn't realize the natives were that heinous.
There's also where he very vividly describes how he took this Native American woman and raped her. So they don't talk about that either. But this just shows you how people just don't have any kind of education, and people are intellectually lazy, and they hear something and then they go for it. And it works the same way in the stock market in a lot of cases. I love my example, and I like my analogy, so I'm going to use this again. But pretend, good morning there, Sean Savage. Pretend you're driving down the highway and you come to a toll booth, right? And it's like there's like 50 cars going into one lane, and people just jump on that line. That's just like your human instinct. That's your bandwagon bias. Now, if you looked around the line and you look up, yeah, you can see that there are other there's a lane with a green light, and then no one's going in it. So you pull out of the line, you go around the traffic and you just go and you go through that line or that lane. So the people that jump on the line are the people that lose money in the stock market. They don't think for themselves. The people that can break away and look ahead and be like, hey, that lane up there has got a green light and there's no one pulling through it, I'm going to just go drive through that one. Those are the people that make money in the market.
Thank you, Mastermind.
Hello, Mastermind. Welcome. So, yeah. So it's the bandwagon bias. And where you got to be careful about that is if, people want to be a member of a herd, right? It's like your natural instinct. And this is being successful in trading is all about psychology and probably other aspects of life as well. But being able to think on your own is so important. And when you become a stockholder, like just say you buy Apple, you become a member of the Apple herd. So you become subject to different biases that human beings have. For example, you might meet someone and they could tell you some good reasons why you shouldn't buy Apple, but you tend to ignore them because it's like, oh, I own Apple. I'm not going to listen to what this person has to say. That's your confirmation bias, where you tend to agree with people that have the same opinion as you and ignore stuff that might be contrary. And it's, it's just a human instinct. Your wife broke it down and explained it. Okay. Yeah.
Hey, wives can be good partners, Sean. Don't knock that. That's a good thing to have.
Yeah, I was yeah, so anyway, so you got to be able to think on your own, and it's like this in life too. It's not just in, I mean, think about fashion, right? Why do people why are some things fashionable? Like clothes become fashionable. And it's like, I guess my point is this: you might think that your thoughts are your own, but a lot of times you're influenced by this external stimuli, right? So you might not even realize it. And this is very important when it comes to the stock market and when it comes to trading, is the ability to kind of just think for yourself and not be a member of the herd. And people think that, People that aren't traders think that there's like the great traders like the Steve Cohens of the world or the Paul Tudor Joneses. They have this like secret formula or these secret systems that they use that are always right, and that's why they're successful. And that's just not the case. The reason why they're successful is because they understand the psychology. We've even seen in the Steve Cohen article from 1999, which I think I will bring up right now, because I think this is something like we should probably read every day.
Hey,
And
Mark,
I was actually there when this interview took place. But Cohen, right down here in this article, right now, this guy is, could arguably be the best trader to ever live. Now he's pretty much just caught up with owning the Mets. And I mean, first of all, look at his returns. Just absolutely mind-blowingly good.
monsters.
He's up 60% when the average fund is up, 8 or 9%. He's up 60, and this is after fees. So he even charges those big fees. But anyway, I just want to point out this thing he says where he says, here we go. Traders have to face their demons. Bad traders blame the market or bad luck. It's neither. It's just bad habits. You have to face your demons. All traders have traits that hold them back. So think about it. A good trader, whether they make money or they lose money on a trade, they say to themselves, what did I do right? Or what did I do wrong? Okay. A bad trader says, oh, it's because of some hedge fund ripped me off or some market maker ripped me off. And it's not, it's psychology. Now, best trader possibly to ever live that we know about. Well, guess what? They have a psychiatrist on staff there, who, he's like a trading coach. So anyway, this is just more evidence or proof or whatever that you should just understand how much of this has to do with the psychology of it. Every trader takes losses. The difference between people that are successful and people that aren't successful is the people that are successful, they don't take big losses. They take small losses. All right. There's no such thing as a trading system that always works. And Cohen even says here, his best traders make money on about half their trades. Now, I think a retail trader could do better than that because these people are trading hundreds of millions of dollars. So they have all kinds of liquidity constraints. But I just think this is a very good article. And, and it just talks about how he has this don't fall in love with your ideas. I've seen him plow into stocks to say within a few minutes, this is stupid. And then he just reverses his positions. But I guess what I'm trying to just emphasize is the fact that so much of it has to do with your psychology and your mindset, right? It's not about like, oh, I'm going to develop this perfect system that always works. Because guess what? You could develop a system that works on paper, but when you go to try to use it, people don't stick to it, right? Like think about the paper trading. Well, the example I give, your paper trading system, and when I say paper trading, I mean you're just trading on paper. You're not using real money. But say your paper trading system says, all right, you got to buy this thousand shares at $10 and sell it if it goes to 15. All right, well, on paper, that's easy. Goes to 11, goes to 12, goes to 13, goes to 15, and you say, okay, I'm going to take my profit here. It's up 50%. This is easy. Now, let's pretend you have real money on the line and it's not paper trading. You put 10 grand down and now it goes to 11, it goes to 12. You start thinking, oh, gee, this is $2,000 here. I'm up 20%. I know my target is 15, but I don't care. I'm just going to sell it because I'm afraid that I might end up losing this profit. So that fear makes you do something which is the bane of a trader. Is you're selling your winners too soon. So you sell it at 12, you think you're great, you pat yourself on the back, but then it goes to 15 and you were right that it was going to get to 15 and you left 3 points on the table. Now let's just say it goes the other way. You say, all right, well, you know what, if this thing goes to 9, I'm going to just take my $1,000 loss and I'm going to move on to something else. I'm going to get stopped out and I'm going to move on to something else. Okay, on paper, that's easy to do. In real life, it goes to 9 and you're like, oh man, I'm down $1,000 here. I don't want to lose $1,000. I don't want to admit that I'm wrong. So I'm going to just hold on to this and hope it comes back. And guess what? A trader should never say hope. Then it goes to 8 and it goes to 7 and it goes to 6. Now, all of a sudden, you got a big loss on your hands. So the fear of losing money makes traders do the two worst things that they can do, and that's selling your winners too soon and holding on to your losers for too long. And this is not just me talking. This is like stuff that I learned back when I was working for Cohen. I mean, this is, if you were to sit down with him right now and ask him about trading, this is what he would talk to you about, the psychology. During this interview, the person kept asking him, like, well, do you use moving averages? Do you use this? Do you use that? And he's like, look, man, he's like, I'm trying to tell you. I'm trying to tell you, like, it's not about the system, it's about the psychology. There are plenty of systems that work. The problem is people don't stick to them, right? It's like having a training system is like having a home gym. It's great to have, but if you don't use it, then it's not going to work.
That's true.
Let's see what John says. I have to. Well, you know what? People, Sean, don't want to admit that they are. Like people don't want to admit that they're wrong. Let me tell you something about hedge funds. Right now, as my role in the head of trading at 3 different money managers, I oversaw the trading of probably about, I don't know, 12 or 15 different hedge funds over the years. And all a hedge fund is an investment fund that charges a performance fee. Okay. Like if you put your money into mutual funds, you pay a management fee, whatever it is, 0.5% or 1%. It's probably less than that. It's probably 0.5% of whatever money is in it. So say a mutual fund manages $100 million and they have a 50 basis point management fee. So that means they get, let me think about this. So they get $500,000 a year for managing the $100 million, right? So that's their fee. Now, a hedge fund, in addition to getting that management fee, they get what we call a performance fee. They get a part of the action. So the hedge fund might say, all right, we're going to take 50 basis points as a management fee, and for a performance fee, we're going to take 10%. So you had $100 million and you get a 20% return. Well, the hedge fund keeps 10% of that 20%, right? That's their performance fee. So they make $20 million. The fund grows from 100 million to 120 million. The hedge fund keeps a $2 million performance fee. So that's the difference between a hedge fund and a mutual fund or a regular institutional money manager. Hedge funds can be very, very sophisticated, high frequency derivatives, options, or they can be plain vanilla and bored, just long-term buy and hold, deep value. Maybe they own 10 or 15%, or 10 or 15 stocks, really just like as boring as you can get. So that's the difference. Hedge funds aren't mysterious. There's plenty of hedge funds that go out of business that don't do a good job. I personally don't understand the whole, I don't know, misunderstanding, I guess, or fascination with them. But that's the difference between hedge funds and a regular fund. It really just comes down to the performance fee. And
so, Mark, do these funds have like single strategies that they deploy, or do they deploy multiple strategies? So, like instead of being just a buy and hold, somebody like one desk will short, one will go long. Do they have?
It depends on every firm is different. Like the way SAC used to work was that they have all these different teams. So, like Cohen was this great trader, but he also brings in teams of people that have successful records, and he basically pays them so much money that they can't say no. So, like when I worked there, the guys on my left were utilities traders. All they did was trade utility stocks and bonds. They just focused on utilities. The guys on my right were the auto traders. All they did was trade auto stocks. So you get all these different teams, and they all have different styles. Some of them might be short term, some of them might be long term. So it's all various different strategies under the one umbrella and that's the SAC model, and that's how like Millennium works and some of these other big hedge funds. And then you get some funds where it's just a single strategy. You just have a portfolio manager, and you're the only person controlling that. What's going to go into that fund, and like the last place I was at, our biggest account was a hedge fund, and it was small cap equities and micro cap equities. And it was buy and hold. There was no shorting. There was no options. And guess what? Guess who the 2 biggest clients of this hedge fund were? Or whose money was it that we're managing in this hedge fund? There were 2 clients in it. One of them was a church endowment, and the other one was a teacher's pension plan. So the hedge funds are not out there managing money for these like oligarchs. hedge funds are managing money for the main clients of a hedge fund is your pension plans. And what are pension plans? Pension plans are the little guy. So there's this whole big myth that these hedge funds are just these big oligarchs that are out there to take over the little guy is just absolutely ridiculous. A guy like this makes their money by getting fees. They get money from a client. Who are the hedge fund clients? People that need money to be managed. The top of the Wall Street food chain is like your pension plans, probably. Your pension plans, your endowments, they need money to be managed. So what they do is when they need money to be managed, whoever's running the pension plan might say, you know what, I want to put 10% of my money into healthcare stocks. So they'll go into their database and they'll look for a fund that has a specialty in healthcare stocks and that has a really good track record. And it's like, all right, well, you're hedge fund XYZ up there in Connecticut. You guys are an expert in healthcare. We're going to give you money to manage. And if you do a good job, you're going to get you're going to get your performance fee. So we give you $100 million and you got a 10% performance fee. And say you're up 50%. Well, the hedge fund gets a $5 million performance fee. So that's the difference. It's not, hedge funds are not out there trying to take advantage of the little guy. I mean, that's like it's like you don't even think about that. I mean, in the 20 years I was in that part of the business, like I never once came to work thinking, gee, how can I go rip off the little guy? Yeah, so Savage there is absolutely right.
Welcome, alien man thing.
A lot of alien stuff going on these days.
Well, I love it, man. They're coming to meet us, and at least they're going to be cool about it. Honestly, as long as they've been around, we should be blown away if they wanted to really get us.
I don't know, man. I was watching some of the highlights of that hearing the other day, and that guy seems like he's crazy to me.
He didn't say a whole lot. I mean, it's all got to be said in a skiff. I mean, I don't even know why you put him on TV except to get us excited.
Well, I guess that's I mean, it's like I've said many times, if these aliens can travel through space and go faster than the speed of light, you would think they would pretty much have fulfilled the scientific knowledge that they can get from probing women that live in trailer parks. Right.
I don't want to touch a nerve, but your man got free of his campaign finance charges. Sam, did you see that?
Oh, scam, Bankman fraud.
Yep, they dropped his campaign finance charges so that no political people have to answer for the money that they took.
Yeah, and I saw that he was the second biggest donor to the Biden campaign.
Absolutely, yes, sir, he was.
Wow, he's a piece of garbage. He should really go to jail. Here's the thing. It's like when the markets are going up, people look the other way. Or maybe they know something fishy's going on, but they kind of or whatever. But then people start losing money. There's no honor amongst thieves. People start losing money, and they all start turning on each other. And that's what's going on over there, right? Is it the guy that or the woman that was his girlfriend is ready to testify against him.
Mm-hmm.
But yeah, I personally think that they should treat people like him just as though he went into your house and stole money from you. Just because it's a white collar crime, he's still stealing money. And he's a piece of garbage, and he should go to jail, and he should probably go to jail for the rest of his life. And you know who else they should go after too? Is his what else they should go after too is his parents. Hello, Charles. His parents are attorneys, so they must have known something was going on, right? All right. Anyway, he's garbage. He should go to jail. He's going to be someone's. They're not going to be worrying about gender pronouns when he's in jail.
It was Listen, Maxine Waters has got plenty of problems with banking in her own right. She sits on that committee, and she was hand in hand with scam, Bankman fraud, and she knows exactly why she just made these charges get dropped by that crooked ass DOJ. So
I think she's hilarious because whenever she's on TV, she just shows how little she knows about how the financial world really works. All right, but anyway, let's look at the S&P here. And it's like yesterday was just another boring day. 19 basis points we were up. We're down 30 basis points in the pre-market. You can see we're just kind of in this range. We did have this negative day. Now, here's what we got to watch. And I think the market is setting up for a move lower. And I think maybe because it's the summertime, things are kind of just moving slower than they usually would. But we have to remember the S&P is 11 different sectors. And what we look at here, I should really get rid of this here to date, but what we look at here is the S&P 500 ETF. It's called SPIDER because it's Standard and Poor's Depository Receipt. So when you hear people talking about the spiders, this is what we're talking about. Now, every ETF has a fact sheet. And if you go look at the fact sheet of SPY, right, SSGA, so type in the symbol in SSGA is State Street Global Advisors. That's who runs these things. And we could go look at our holdings. And here are our sectors, okay? So utilities, materials, real estate, these are really small. They're all about 2.5%. So they're not really going to have an influence on the broader market. Energy is only 4.3%. And believe it or not, when I started doing this 3 decades ago, energy was the biggest sector. And now it's only 4%. So it just shows you how things change. But energy, even though it's only 4%, it can have an impact on the broader sectors. So we watch energy. I mean, we watch all the sectors. Consumer staples is small too, but sometimes money starts flowing into consumer staples right before the market goes lower. And that's our classic flight to safety. And then I like to say different things are in the driver's seat at different times. Sometimes it's about tech. Sometimes it's about financials. Sometimes there's one sector that's in charge. Sometimes you got to look at a couple different sectors. But in the institutional trading world, the trader is the person who's supposed to be the eyes and ears into the market. Basically, you in the institutional investment world, or your hedge funds or your mutual funds, you have 3 roles. You have your portfolio manager, and that's the person who decides what's going to be in the portfolio. What do you buy? What do you sell? Then you have your analysts who kind of support the portfolio manager. And then you have the trader. So the portfolio manager says, hey, we're going to buy XYZ. And the trader is the person who decides, okay, well, this is the best way to buy it. And my role, I was the trader. So as the traders, we're supposed to be the eyes and ears into the market. So the traders generally run the morning research meetings. I would go in there and do my spiel and, tell everyone what's going on. And then I would leave and go back to the trading desk, and they would all decide what they wanted to do. But that's why we look at these sectors. Now, right now we got tech is teetering right on an important level, and financials and healthcare have run into resistance, and consumer discretionaries have run into resistance. So let's see. So that's about 25, 50. So that's over 60% of the market. That's about 2/3 of the market look a little vulnerable. So the tech sector spider is XLK. So we're going to look at that. It used to be really hard to get charts of these sectors, but now that we have all these ETFs, we can do that, because they don't want to. The companies that run these sectors, they want to sell the information. So it used to be hard to get charts of it, but now we can easily look at this. So here's our XLK. Once again, we're toying this 177 level, right? 177.50 in the pre-market. Now look at this. Why is 177 important? Well, back in here in January of 22, or the very end of 21, when the market peaked, this is where we ran into resistance. This is where we ran into resistance again on June 16th. So it's not a coincidence. There tends to be resistance at former peaks. And that's because of psychology. There are people who bought shares here who come to regret doing so when the market goes lower, and they tell themselves, damn, I made a mistake. If this ever gets back to the price I bought it at, I'm going to sell and I'm going to get out at break even. So you have these remorseful buyers placing sell orders at the level that was the former peak. And if you have enough of them, the level that was the peak becomes resistance again. And that's what happened here. Now we have a different psychological phenomena going on. Seller's remorse. People sold here and they thought they made a great decision when the market went lower. But then when the shares go higher, a lot of them tell themselves, I shouldn't have sold. I want to buy my shares back, but I'm only going to buy my shares back if I can get them for the same price I sold them at. So if you have enough of these remorseful sellers placing buy orders at the level that was resistance, it can convert into support. And that's what happened here. In the markets, there are some price levels that are more important than others, and that's just how it is. And if you want to be a successful trader, you should really know where these price levels are. I mean, I have a hard time picturing someone being very successful if they don't understand this. When you look at a chart, you're looking at a graphical illustration of psychology. All right, so we see buyer's remorse. I mean, this chart teaches a lot of lessons. So buyer's remorse made resistance or formed resistance at a former peak. Buyer's remorse can also turn support into resistance. There's people that bought here when it was at support, and then the price goes lower, and they tell themselves, I made a mistake. If I can get out of this at break even, I'm going to. So you have remorseful buyers placing sell orders at the level that was support. So when we get back up there, you got these remorseful buyers placing sell orders, and if there's enough, what was support turns into resistance. So support turns into resistance. Support turns into resistance. For some reason, these price levels are important for this ETF, and I don't know what the reason is, but I would say 164 and 141. Now, as we're moving higher, what's the characteristic of a market that's moving higher? Well, you got a lot of seller's remorse. People sell and the market moves higher. So, seller's remorse is a common thing. You have people sell, price goes higher, they experience remorse, and they tell themselves, I'm going to buy my shares back if I can get them for the same price I sold them at. So if you have enough of these orders, what was support converts into resistance. What was, I'm sorry, I said that backwards. What was resistance converts into support. What was resistance converts into support. What was resistance converts into support. And now we've seen this again. What was resistance converts into support. So you got to know where these price levels are. That's kind of the, I don't even really know what to say. It's like one of the basic things you need to understand is the psychology. And I talk about levels, trends, momentum, and psychology. We don't do things like Elliott wave and Fibonacci and Gann theory. If you can make money with that stuff, that's great. In my opinion, that's all science fiction. And in the institutional trading world, I've never once ever heard anyone talk about Fibonacci or Gann theory or Elliott wave. People look at things like this. Where are the important price levels? Because when you're trading a lot of money, if you're a trader and for $3 or $4 billion fund, you're going to have a lot of liquidity issues. You're not just going out to buy 100 shares. You might get an order to buy 10 million shares or something like this. So you got to, or sell 10 million shares. So you got to know which levels the buyers are at, which levels the sellers are at. Where can you get your order executed? Just because it's trading at 177.50 doesn't mean you can buy or sell all your shares there. I mean, if you want to buy and you got a huge buy order, you might drive the price higher, or vice versa. If you have a big sell order, you might drive the price lower. So this is the stuff that we focus on. All right, now the second biggest sector is healthcare. So we're going to take a look over here. And if we see a sector that looks like it's really making a move, then we can look at the stocks within the sector for trading ideas. Now here we have our second biggest sector ran into resistance. Remember, levels that were former peaks can become resistance again. Why would something sell off of resistance? Once again, it's because of psychology. It's not because of, the debt ceiling or whatever. It's because there are investors who want to sell. And when a market's moving higher, there's not enough sell orders or supply to fill all the demand or buy orders. So the buyers are forced to pay a premium, and that drives the price up. When we get to a resistance level, the tide turns. All of a sudden, there's enough supply or sell orders to fill all the buy orders. The buyers don't have to worry about pushing the price up anymore. But guess what happens? Some of the investors who want to sell start to look around and they start to say to themselves, hey, the price isn't moving higher anymore. That must mean that there are new sellers coming into the market. And then some of these sellers start to worry and they start to think, if someone is willing to sell at a lower price than me, that's who the buyers are going to go to. Of course, the buyers are going to go to who's ever willing to sell at the lowest price. So what happens is you get these anxious sellers start to reduce their prices that they're willing to sell at, and they start to undercut each other. And this turns into a snowball effect. So a lot of times you get to resistance, you get these sell-offs, and it's because of psychology. It's not because of what they're talking about on Bloomberg TV or Fox Business News or CNBC. It's because of psychology. As a matter of fact, I tell my students, turn the TV off, don't go into chat rooms, just let the market tell you what to do. And personally, I think if I was on a desert island and I had my charts, but I didn't have news, I don't really think my analysis would be that much different. But anyway, this is why when we get to resistance, a lot of times we tend to sell off. And then the opposite is true when we get to support. When a market's moving lower, there's not enough demand or buyers to absorb all of the supply or sellers. So the sellers are forced to offer their shares at a discount. and that causes a downtrend. When we get to support, all of a sudden the tide turns and there's enough demand or buyers to take in all the supply. Now, some of the investors who want to who want to buy, notice the price has stopped going lower. And they say to themselves, gee, the price is not going lower. This must mean that there are new buyers coming into the market. So what do? They start to raise the prices they want to pay or are willing to pay, because the sellers are going to go to whoever's willing to pay the highest price. So you get a snowball effect. So things get to resistance and they tend to sell off because of a snowball effect. Things get to support, they tend to bounce because of a snowball effect. So you have to look at these charts through the prism of what does this tell us about supply and demand. A lot of technical analysts will see like a pattern and they'll be, oh, well, this looks like it's a wedge or this looks like it's that. But they don't really understand about the psychology. And if you don't understand that we're looking at psychology, you're going to have a really hard time understanding this. Think about it. This is the financial sector. Okay. This is a sector that's worth trillions of dollars. How is it possible that we have the exact same valuation now that we did back in February or that we did back in January? Interest rates have changed. The price of oil has changed. We've had the banking crisis. Everything has changed, but yet somehow we have the exact same valuation. Now, when I was in business school a long time ago, they used to teach us or try to teach us that the market follows a random walk. And if the market followed a random walk, well, guess what? Every price level would be of the exact same importance, and you wouldn't have support and resistance levels. But clearly, we do. You could just look at pretty much any chart and see it. So we ran into resistance here. Now, it's not a coincidence that we're at resistance around 35. Look at that, 35.30. That's exactly where we are right this day right here. Opening price, 35.32. This day here, opening price, 35.38. So within pennies. So it's not a coincidence that this is where we ran into resistance. It was a support level. Now, how does this help you? Well, just say you buy something and it's going higher and you're wondering, where should I sell it? Well, if you look into the past and you see that it's getting close to a level that had been support or resistance, there's a good chance that that's where it stalls out and rolls over. I mean, of course, it could keep going, but there's no perfect answer, and we just got to stack the odds in our favor. Now, just say someone buys this down here at 30. Let's just say they buy it at 33, and they say to themselves, you know what? I'm going to sell this if it gets to 36. Well, in that case, you're just guessing that it's going to get there. You're just pulling a number out of a hat. And maybe it does get there, but you might be better off letting the market tell you what to do and looking at this and saying, you know what? There was support around 35.30. There's a good chance there's going to be resistance there. So instead of having my sell target at 36, I'm going to have my sell target at 35.30. All right. And that's letting the market tell you what to do. And when you let the market tell you what to do, the market's always right, right? So, the market's always right. So you're better off letting the market tell you what to do than just guessing. Here's our consumer discretionary sector, which we can see is also below resistance. See this 173 level? I mean, look where we are in the pre-market, 172.84. It's really just amazing. And I mean, look at this here, right? Resistance became support, support became resistance. I mean, you could see this on pretty much any chart of anything that's liquid enough. You're going to see these patterns. And why do we have these patterns on different securities, so cryptos or bonds or commodities? We could see here support became resistance, resistance became support. It's because we're looking at human psychology, and humans trade various things. So we're looking at the psychology of different people, but this is why we see the same patterns in different securities, because it's human psychology, and human psychology hasn't changed. I mean, we could look at charts from 150 years ago and see the same patterns that we see now. Guess what? 150 years ago, people had buyer's remorse. 150 years ago, people had seller's remorse. Let's take a look at oil. I think this is a really good example, because if you think about how big the oil market is, trillions of dollars all over the world, there's all these big tankers out there in the oceans and pipelines and so forth and so on. And yet somehow, look at this, we get a perfect resistance level at a level that was support. So this is 82. So support became resistance. And why is this? Why does this happen? Well, it's humans are trading this. Here we have our phenomena. We get to resistance and we sell off. Remember, we get nervous sellers undercutting each other, get to resistance and sell off. Now, I mean, we'll have to see what's going to happen here. My guess is we're going to sell off. And the first of every month, and today is August 1st, this ISM report comes out. And this is pretty bad here, all right? Generally speaking, if we're below 50, it shows contraction. So PMI means Purchasing Managers Index, and this just came out this morning. So this, I haven't really had a chance to go through this, but 46 is contraction. So the manufacturing part of our economy is in recession, right? There's also the service sector, which is doing well. So you have manufacturing, services, and hospitals. So services are doing well, hospitals are doing well, but manufacturing is not doing well. So that's it probably means that oil will probably go lower. And this is kind of a cool report. They go through here and they ask the respondents about what's going on in their part of the world. And the slowing U.S. economy is causing business forecasts to be revised or reduced. What's kind of interesting is back in fall of 21, when they were still telling us this myth about inflation being transitory, there were 2 months in a row. I think it was either September and October or October and November, where every single commodity that they follow was up, commodity up in price. There was probably 100 different commodities here. There was not a single one that was down in price. So you don't need to be an economist to see, oh, every commodity in the world is going higher. Gee, maybe there's inflation. So I don't know why Janet Yellen and Jerome Powell didn't see this. Maybe she was too busy,
Shrinking it up.
taking mushrooms and bowing.
She was chewing cats in China.
Yeah, dude. She's a. I still think that bowing thing has got to be one of the funniest things I've ever seen, because here's the thing, everybody, right? You don't bow in China. Bowing is a Japanese and a Korean tradition. So she's in China and she starts bowing. It's like, what the hell, man? But anyway, so this is something we got to look at here. So this is recession. And then you can see here that they have these other reports. Hospital is actually pretty new. It's only within the past couple of years. But let's hear services PMI. And now see this sector, or this is growing. See how this is above 50, but it's still, it's getting pretty close here. 53. Anyway, so that's just telling us something we probably already knew, that the economy is slowing down. And then you have your hospital report, and look at that. That's 51. So this is, remember, anything below 50 is slowing down. So this is kind of trending lower. Oh, look at that. We actually even had below 50. So 53, 55, 51. This is one of these sites that it's free and you get a lot of really good information. And I like looking at sites like this because they're not trying to sell anything. It's like if you look at a research site or a broker, they're trying to sell something. So they're going to be kind of tainted. But this is this is something where they just put the stuff out. It's the Institute for Supply Management. I would imagine that there's probably some stuff you have to pay for, but you can get a lot of the basic information for free. We also look at this website, this AAII sentiment website. This is another free one. And what we look for here is extremes. And if we get an extreme amount of bullishness, that's actually bearish for the market. So that might sound a little counterintuitive. And you might be saying, well, gee, Mark, if most investors are bullish, isn't that a great thing? Well, here's the problem. If most investors are bullish, what do? They go out and they spend their money and they invest their funds. And when the market runs out of investors, or when all these people invest their funds, the only way the market can go is lower, because it's run out of buyers. So this is why we get extreme bullishness. It's actually a bearish thing. The last time that we were up in the 50s was right at the end of 2021. And that's right when the market peaked. So we kind of sold off a little bit back to 45, but this is pretty high reading. And this is one of the reasons why I'm kind of bearish now in the short term, because we got a bunch of sectors that look technically vulnerable, right? We just saw healthcare. Well, healthcare is selling off. Financials are at resistance. Tech is teetering on support. very bullish sentiment. It looks like we got the makings of a new downtrend to me. But again, it's August, and I think things are kind of moving slower than they typically would. Oh, look at this. Uber delivers first ever operating profit. Let's take a look at Uber.
Wow.
I take Uber all the time because if I'm going out to dinner or something and I know I'm going to be having some cocktails, it's like I just Uber it. All right, now here once again we got our same principles, right? Resistance here became support over here. Why do we sell off of resistance? Nervous sellers undercutting each other. Why do we bounce off of support? Nervous buyers outbidding each other. Now let's see where we are here. I should really get rid of this 15 months. Let me just get rid of that so it's less confusing.
I've noticed a lot of times, Mark, when these companies fall off the actual news radar and they're not pumped all the time, they actually start to come back and be able to focus on their business model and actually build a business that actually can profit.
Yeah. Oh, yeah. I mean, they get, it all depends on the management, I guess.
Mm-hmm.
Like we saw that Mullen Automotive, the stock went from like 10 to like, I think it's at 15 cents now. And, they're blaming the naked short sellers. And it's like, come on, man, your stock is a penny stock because you're losing a ton of money. Don't blame the short sellers. And as someone who was in the institutional world for so long, I can tell you this. I don't even know how you can naked short sell. Naked short selling means you sell a stock you don't own. If you want to short something, you got to borrow the shares from someone else and you sell them, and then hopefully you buy them back at a lower price, return the shares to whoever you bought them from, and you keep the difference. So a naked short sale is the sale that happens without a person borrowing. Now, in the world I was in, it would be impossible to do that. First of all, when you call up a broker and you got to tell them if you're shorting a stock or not, because there's different rules for shorting than there are for regular selling. Then they're going to say, oh, it's a short. Where did you get the borrow from? Like, in other words, where did you borrow the shares? What's the code? And you have to type in the code of what your borrowing confirmation is. Also, when you sell something, it's got to come from somewhere. It's got to come from an account. And your accounts are your like I talked about before, your pension plans, your endowments. So if you go ahead and you sell a stock that you don't own, the next day the custodian or the people that are at the pension plan or at the counter are going to call up and be like, why did you sell a stock that we didn't own? Right? It shows that my portfolio is short 10,000 shares of Mullen Automotive. We didn't own that. Why are you selling it? So I personally don't even know how an institutional trader could sell something naked, can sell a naked short. I mean, I just can't conceive of it. I think a retail person maybe could call up a brokerage firm and say, hey, listen, I want you to sell. I got the shares here at my house. I got my stock certificate. I'll bring it down into the office and deposit it. But I can't see how that could really happen in the big world. Now, a friend of mine is a market maker at Goldman Sachs. I was asking him about it. And of course, Goldman Sachs is very highly regulated, so they wouldn't be able to do that there. But maybe he said maybe there's this like lower tier of all these like kind of mom and pop broker dealers where someone calls up one of these broker dealers and says, hey, I want to short 10,000 shares of this. And they might not have the shares to lend them, but they call one of their friends at another mom and pop broker dealer saying, hey, do you got 10,000 shares of this that I can lend to this person? Because we don't want to tell a client, oh, sorry, we can't do the order for you. And then they lend him the shares, and then someone else calls up that second broker dealer and says, hey, I want to short 10,000 shares. And they don't have the shares, but they say, oh, yeah, we do have them, because they just assume they're going to get them back in time. But the trading world is very, very regulated. And I mean, they read your emails, your texts, your chats. It's just, I like I said, I mean, I don't know. I guess these days nothing would surprise you, but I don't see how you could possibly make it short. Well, look at this, man. This stock went from, this is pretty amazing, from $4,400 to 12 cents. So I guess it's not, I guess it's very understandable why why they're so angry. But it's just like with trading. The traders who lose money, they don't blame other people. They ask themselves, what am I doing wrong? This company here is a penny stock because the management probably sucks and they're losing a lot of money. So don't blame the short sellers because it's your fault, right? And then the other thing is, how is short selling any different than long selling? Both people think the price is going to go lower, right? So what are you going to do? Just ban selling? Okay, you can buy your stock, but you're never allowed to sell it. You know,
Yeah, right.
I mean, seriously, it's just one of these other things that people don't. Oh yeah, Miami is shrinking. That's down in your neck of the woods there.
Mm-hmm.
I don't understand how people can naked short sell it, and this is nothing new. This goes back through history, right? It's like there's always sour grapes and people whose stock gets ruined or crushed, and they blame the short sellers. And there's like this evil connotation of short sellers. But guess what? If you're a short seller, you have to buy the shares back. So for every short seller, you have a guaranteed buyer. So a big short interest in a stock could actually make the price go higher. So that's another kind of a thing that people don't understand. Let's take a look at JB Hunt. Looks like
They
there's some
should
news.
be having some sympathy off of that. They were actually looking to buy some Nikola trucks.
Yeah, well, I think that it's. I mean, I don't know if it's going to happen here, but I think we're going to see a lot more things going on, like happened at Yellow, where they'd have to default on their pensions because people just went to the well too often. I have a good friend who worked for the Long Island Railroad, and he retired. I don't know when he was 55 or 60. Now he's probably 65 or 70. Dude, he gets a full salary. He's making just as much now in retirement as he did when he was working.
That's
And
crazy.
and how long can this go on for? How many people can get full salaries? I mean, it was different 50 years ago or 100 years ago when people only lived to be 60 or 65, but now you got people living to be 100, right? When we first moved into my house here, my neighbor was the retired chief of the Greenwich police, and he was like 50 years old, and his pension was like $200,000 a year, and he just moved down to South Carolina because he's a big golfer. He's a 2 handicap, and
Damn.
so say this dude lives to he could live another 50 years. And if his pension is salary or is inflation adjusted, he could be 95 years old and his pension could be $250,000, $300,000 a year. Now, a town like Greenwich is very wealthy, so maybe they can support that. But a lot of places, there needs kind of be this whole like reset, right? We had the Great Depression, and then Franklin Delano Roosevelt came out and put in the New Deal, and one of the parts of the New Deal was Social Security. Well, guess what? When they first put in Social Security, the average person didn't live long enough to get it. I don't know how old you have to be to get Social Security. Maybe just say 60, and the average person lived to be like 59. I'm not sure if those are the exact right numbers. But now you get people that live to be 100. So there's got to be a reset. And the answer is, well, we need to raise the retirement age. But I don't think any politician is going to come along and say that that's what we should do. I mean, they just tried to do it in France and they had riots. But, something's got to give sooner or later. The chicken's got to come home to roost. I mean, we're $31 trillion in debt.
I think that the politicians should have to be held to some sort of standard. I mean, they go in there, they lie their way to the podium, right? They say whatever they want to say on the campaign trail, and then they get in there and they do whatever policy they do so that they can get themselves reelected to keep that cushy government job. And so it doesn't really matter to them the budget or the money that they're taking from a small family or something like that. They're just doing what they can do to keep their job, and that's really all they care about.
Well, I think if
And
you had term limits and people didn't worry about getting reelected, then maybe they would do the right thing. And I mean, it's like, come on, man. It's like look at
Mark,
Barbara Boxer or McConley. The dude basically had a stroke the other day. It's like
we could get better governance out of a national lottery that picked 400 or 545 people every 2 years. You got selected to go work in Congress for 2 years, and that's what happened. Your number gets picked, you got to go up there and deal with the shit. That's it. And then you come out and you go back to being an American. But that way, everybody's got some skin in the game. And you know what? You probably get smarter people getting picked by the lottery than we do get picked by voters.
Yeah, well, I think to be a politician, you got to be a real, real kind of egomaniac. I mean, like I would never want to be. If someone said to me, "Hey, Mark, we could make you president tomorrow," well, maybe I would become president tomorrow because it would be a key way or easy way to make a lot of money. But like they're talking about, oh, maybe they should run Michelle Obama by the Democrats. Like, why would she want to run? I mean, they're fabulously wealthy, and people are just going to go through their past and through the dirt and so forth and so on. But anyway, I mean, it is what it is. But I think anyone who really wants to do that has a really big ego. Like look at our, we're in Connecticut, our senator Blumenthal. I mean, the freaking guy's 80 years old and he still dyes his hair. It's like, dude, come on. We know you have gray hair. Why do you still have to dye your hair? You know what I mean? Anyway, here's Caterpillar. They reported, but I want to just show you here. Here's our examples of what was resistance, became support here, support over here. Now we're looking up a little bit this morning and notice how we stalled out at resist, right? See, I don't make this stuff up, man. This is true. We get to former resistance levels and we run into resistance again. Now this morning we're trading up above this. When we get above a resistance level, we call that a breakout. And that tends to be bullish because what is it showing us? What is the chart illustrating? All right. Resistance is a large group of investors who are trying to sell at or close to the same price. In this case, it was around 263. Now that we're above that, it tells us that the investors who wanted to sell are out of the way. Maybe they cancel their orders, maybe they finish their orders. We don't really know. But anytime you take supply out of a market, it sets the stage for the market to move higher because now if buyers are coming in, there's not enough shares to fill all their orders, so they're going to be forced to try to pay a premium. So when people talk about a breakout, that's what it is. And this is a really good example of how markets are moved by psychology and not by fundamental reasons. Caterpillar is up, let's call it 30% since the beginning of June. So what happened in the last 2 months that made this company gain 30% of valuation? Like, do they discover some new tractors that they forgot they had or, nothing. It's just the psychology has changed. 30% move in 2 months is a big move. But I think this just really goes back to show us how much of this stuff is psychology, right? I mean, when it's getting resistance at a former resistance level or support at a former support level, it's people think that there's like some kind of secret formula, but there's not. Oh, let's see, Merck reported as well. Pfizer too. Let's take a look at Pfizer. They had that fire down in somewhere in North Carolina. I think it was actually a tornado. But look at this stock is really falling apart here. So where are we trading in the pre-market? 36. All right, so I guess we're kind of right at the support level here. But even here, we could see certain of our principles, right? Support here became resistance over here. A lot of times you'll, as you get more experience, you'll put a line on a chart. And then, look at that, resistance. And then you might not look at that chart for like a few weeks. And then you come back to it. And it's like all of a sudden you see like, oh, man, there was like support or resistance right where I put the line. And then take a look at Merck. What's going on here? So this is looking up just a little bit. I mean, 95 cents. So there's nothing really huge there. But once again, you see these principles. This is something that we see where I don't really hear other people talk about this besides me. But a lot of times when you get a rapid move through price levels, when you get back to those price levels coming the other way, you get a rapid move back the other way. See, sometimes we trade in these ranges, but this is because when you're moving really quickly, you don't really have a lot of time for there to be a big vested interest forming. What's one of the reasons why we get resistance? Well, we have remorseful buyers placing sell orders so they can get out at break even. When you fall really quickly like this, or when you have these gaps, in other words, price levels where there's no trading. Well, guess what? No one bought there. So if no one bought there can't be remorseful buyers who are trying to get out. So when people start to say, boy, you know what, that sell-off is overdone, I'm going to go in there and try to buy some shares, there's just not a lot of sellers around. So they're forced to pay higher prices. Maybe they come in here with some big trader comes in with 1 million shares to buy, and stock is at 86.50, and maybe they can only buy 100,000 shares there. Maybe they got to pay 87 for the next 100,000 or 87.50 for the next 100,000. So this is so this is our psychology. And so you go fast through markets one way or through price levels one way, and when you reverse, you get back to those price levels. You can see fast moves going the other way. And that's something else you can see on pretty much any chart. Like, let's look at while we're in healthcare land here, let's look at this. And we can see, like, look at this. Here's a perfect example, right? You get your rapid move lower, and then for whatever reason, people say this move is overdone. I'm going to go in there and start buying. Well, there's not a lot of sellers around, so you're forced to pay higher prices. And yeah, we can see there, like, fast move up, fast move down. One of the reasons why we get support is because you got remorseful sellers trying to buy shares back. And when you really rip fast through these levels here, you just don't have a lot of time for there to be this large group of vested interest to form where you're going to have a lot of sellers trying to buy their shares back. So, important thing to understand with trading, if you're looking at something to buy and you notice that it's starting to get to levels where the last time it was at those levels, it moved through them really quickly, there's a good chance it's going to move really quickly back the other way if it does, in fact, go that way. All righty, so let's go see what's going on over here. Manufacturing stalled in the first half. Yeah, well, that's surprising. All right, if no one has any questions, I think I'm going to get going. I do have my 9 o'clock call I got to do.
Thanks, guys. Thanks for coming and hanging out with us today. If you don't mind, please like, subscribe, and share this stream with all your friends. And
yeah, tell your friends. We want to try to build a really kind of good community here.
And the more questions you ask, the more you get out of this. Trust me, I picked Mark's brain until he hired me. So,
and we want people that want to learn, and as opposed to being told what to do. So.
Yeah, you won't get trade. You won't get enter here and exit here from us. You're going to get a perspective of what you should do from a bull and a bear perspective, and then you should work from there through it on your own.
Yeah, because everyone has a different style and everyone has a different personality, and what works for one person might not work for another person. Now, why are they showing guitars here being made? This is kind of interesting. I'm going to have to look into this. All right. And speaking of guitars, it is Jerry Garcia's birthday, so we'll have to do a little celebrating. CVS to cut about 5,000 jobs. So let's go to CVS.
Listen, man, I'm telling you, things are not good. And this bull run has just really kind of got me kind of out of whack. I didn't expect this to last as long as it has. But like you said, you can't fight the trend.
Yeah, exactly. And you can't. I don't want to say the market's not rational, but people aren't rational. And what is the market? The market is the actions
of
people, right? So, all right, everyone, thank you so much. And I will see you all tomorrow morning.
Later, guys.